So there's no one size fits all solution. What is really critical is that the messaging that you put out there is uniquely you.
Welcome to the Service to Syndication Podcast, where we interview the biggest and most successful real estate entrepreneurs, investors, capital raisers in the world who have worn the uniform of this great country, those who provide services to our men and women in uniform, and other service-oriented professionals to provide you with the tool sets, the mindsets, and the skill sets to help you conquer your dreams and goals in real estate and to use this wealth creation vehicle so you can live a more successful, happy, and fulfilled life of generosity and prosperity. If what you desire is time, lifestyle, and financial freedom, you've come to the right place. We will bring to you the best real estate entrepreneurs who will give you the insights, the knowledge, experience, skills, so you can go out and crush it in whatever real estate asset class you desire. So grab a pencil and paper, sit back, and enjoy the ride on the Service to Syndication Podcast.
Hello, my servicemen and women and other service providers. Welcome to another episode of the Service to Syndication Real Estate Podcast. I am your host, Cedric Marlow. I am a U.S. Navy vet. Here on the Service to Syndication Real Estate Podcast, we interview the most successful real estate entrepreneurs, investors, and capital raisers in the world, where most have donned the uniforms of our great country. We aim to provide the tool sets, the mindsets, and skill sets for you to achieve your personal and business goals while using real estate as a wealth creation vehicle to help you live a more successful, happy, and fun-filled life. I am super excited today because I have with me Dr. Adam Gower, who is a top-notch capital raiser. But before I properly introduce our exciting guest to you, I want to ask a favor of you, please. If you get some value out of this interview, if you get some value, some type of insight, mindset shift, if you learn a new skill, new information, receive inspiration or motivation to go out and take some progress in your life, please share this episode with some of your friends. Send it to someone you know who might be or could be interested in real estate. Share it on your social media, post it on your wall, or share it in your stories. Help us spread our message while you help others. And for all of you who shared this episode, I want to say thank you. And I know you're going to get a lot of value out of this interview. So like, subscribe, and comment so you'll be notified for future episodes. Again, everyone, I have with me Dr. Adam Gower. He is a 30-year veteran real estate investment and finance professional who is a PhD graduate of the University College London. Dr. Gower is the world's foremost expert in online real estate capital formation through crowd-funded syndications. He builds best-of-class digital content, marketing systems for developers who want to expand their investor network to raise equity online. He hosts an internationally syndicated podcast on real estate crowdfunding, and his real estate education courses have been distributed to investors in over 100 countries worldwide. Dr. Gower has taught courses in real estate investment and finance on faculty at Cal Poly, San Luis Obispo, and as a guest lecturer on the University of Southern California's MRED program. All right, Dr. Gower, welcome to the podcast. Usually I have my guests to start out by going through their real estate journey in 75 seconds or less, but I'm not quite sure you'd be able to do that with 30 plus years of experience.
It's not so easy, but I will tell you there's one thing actually missing from that bio that you very kindly read. That I actually don't normally share because I'm a little bit concerned that people might react negatively. You never know these days. But considering your audience, I will share with you that I was also an LAPD officer, Los Angeles Police Department officer. So not military, but I worked with a lot of military, retired, separated military.
Yes.
For LAPD. and I really enjoyed that company. I started my career in real estate pulling wires for an electrician in early 1980s, and very soon thereafter I ended up uh, working for a ground up multifamily shop, raising capital for them. And I raised in 1980s money about 30 million. So today that's got to be 10, 20 times that. I mean, in those days, a huge amount of money. Then there was the savings and loan crisis, which predates you, I think, which was the early 90s. And I ended up going to Japan. I'd raised a lot of money in Japan to help them with workouts, and so went through that process, learned to speak Japanese, and was hired by Universal Studios to run Asia Pacific, all their real estate developments in Asia Pacific. When I finished that work, I came back and did my own developments, and in 2007 sold out. So I got lucky right before the global financial crisis. Sold out, was hired by East West Bank, a major regional bank headquartered in California. And my job there was to work on non-performing real estate collateralized loans. So I sold about $1 billion worth of those, and then was hired by Colony Capital. So Colony had done probably 7 to 8 billion by the time I got there, in partnership with the FDIC, all non-performing real estate collateralized loans from failed banks. And what I did there was repackage those into portfolios and sold them to investors. So once that had happened, I'm trying to keep to 75. No, I'm probably at 75 minutes already. But anyway, once that had happened and the market started to pull up, I started doing seed and angel investing, kind of venture capital style stuff. And that's where I learned the art of digital marketing. Now, I'd never come across it before, never really knew anything about it. But all the deals that were pitched to me in my little seed group were the consistent thread was how to do marketing online. And so when the Jobs Act of 2012 was passed, which allowed for general solicitation, that's really the reason that you're sitting here today, is that law was passed. Obama signed into law bipartisan bill, the Jobs Act of 2012. That allowed for general solicitation. In other words, it allowed sponsors to advertise, which in turn meant they could go online for the first time in history. And so that's where I put two and two together, one and one together or something anyway. And that was digital marketing and real estate to raise capital online. And so we've been at the forefront since then. We were the first in the industry to start building systems for sponsors. And we are at the forefront of the industry today. One last note, our clients manage or handle over 35 billion, it's actually more, but 35 billion of assets under management, and have raised probably close to $1 billion with minimums as low as 25,000. So that's it. Probably longer than 75 seconds, but that's what you get.
Yeah, no. Look, I'm happy with that. And of course, I'm from America, so we would say that you have a little bit of an accent. So tell us where you're from.
I will. So I like to say that I'm from Lubbock, Texas. And whenever I say that, you'd be surprised how many people say, really? And that's when my wife kicks me under the table. I don't do that. But anyway, so I'm from Northern England originally, but it's been a very, very long time since I was in England. Yeah.
This interview is going to be for my listeners, but it's going to be for me as well, because
sure,
as most people who are in this space, raising capital seems to be that one sticking point that we all deal with.
So what's your major problem that you want to talk about?
So, sure. So you've been in the real estate industry for over 3 decades, right?
Yeah.
What originally drew you to real estate investment and finance, and how has your approach evolved over the years?
Well, in England, growing up, my family actually was very heavily involved in real estate development, mostly both in the UK, but also in Spain. There were all kinds of wacky tax circumstances that pushed a lot of people onto the continent in those days, but it was a very long time ago. So that was really the first kind of appreciation of the wealth that real estate can bring to somebody. But that was when I was very young. Sorry, what was your question?
Yeah, no problem. So, what originally drew you to real estate
That's right.
and finance, and how has your approach evolved over
Yeah, that's right. Okay, so I had that kind of youthful experience as a really just as a little kid, and exposure to it that way. But I would say that the attraction to me were the numbers, to be honest with you. I mean, when I really decided I was going to get deep into real estate, I remember it clearly. I was having, so I joined this little shop in Southern California that was doing mergers and acquisitions. It was a little Japanese boutique M&A shop. And I used to have breakfast occasionally with an old family friend, coincidentally, who was doing ground up multifamily in Southern California. And one day he started talking about the economics of the deal. He might have even pulled up a pro forma, actually, and showed me how it works. I probably asked him, well, how do you make money? How does it work, this whole thing? So we went through all the cost input, the revenue inputs, the cost inputs, the pro forma. They did ground up. This is how it works. This is what a cap rate is. This is how we calculate value. And this is how we make money. And I just thought, oh my goodness, that is incredible. It's like you can make so much money doing this. Of course, I had no sense, Cedric, seriously. And this is a very important point to make, especially of people who are new to the industry. And when I say new, I mean within the last 10 years, is that I had no sense at all of the risks that were involved. I was looking at a pro forma. I was a friend talking to me. Of course, he was just shedding the brightest possible light on what he was doing. He was just saying, this is how we make money. There was no cause for discussion about risk. I wasn't part of the conversation.
Of course.
And the other thing that I remember from those days was, first of all, it was ridiculously easy to raise money. When I started doing it, how old was I? Let me just think about this. So I was 22. Imagine, 22 years old, doing pitches to audiences of very high net worth investors. Basically going through these pro formas and explaining how it worked. I had a knack for knowing how to narrate the story of these deals. And that's how we raised capital. But it was very, very easy. And the other thing that people said was, I repeatedly heard the term, this time is different. But I didn't really know what they meant. Different from what? I'd never seen, what do you mean different? Different? How different from what? I don't know it. Different. So everything's different to me. I've never seen it before. And the common refrain was, population growth is so high, there's never going to be a downturn. It's just not possible, right? Economics kind of... And then there was the savings and loan crisis. And that wiped everyone out. I mean, literally everything was lost. The sponsor I worked for went bankrupt. The investors lost everything. It was total disaster. So this was my formative, and I'd made, Cedric, seriously, I mean, I'm working for this sponsor. I was compensated with GP economics as well. So I was paid shares as well as the salary. So on paper, I had this stack of offering documents, signed agreements. And in my head, I thought, gosh, I'm a multimillionaire, 20, whatever I was, right? Mid-20s. So they paid me well. And I just spent my entire salary on high living. I was single. So I bought a Mercedes. I lived in a fancy apartment. I was a young guy. And we had mobile phones. I mean, these were, I don't know, they were batteries, but like these massive heavy batteries with literally like a handset with a twirly cord to it that you would, we had those. I mean, we were at the top of our game. We was amongst the first to have them. We were flashy. We lived the high life, and then the bottom fell out, and we lost everything, literally lost everything. So it was formative on my experience of real estate that yes, you can make money, but you can also lose everything. And so you've got to approach the industry and you've got to approach investing with considerable caution. Can I give you an example that comes from my police work? Would that be okay?
Go. Let's do it.
So, when I went through the academy, they taught us how to slice a room when you were going into a room and you didn't know if there was anyone in it.
Yeah.
So, and it was just this very, very patient process of slicing the room, and so you could see everything, you got backup and everything. But it was very, very deliberate and very, very slow and very, very safe. Okay, so that's how we learned how to do it. But in the field, when I went out in the field, I remember this one time somebody had broken into a Porsche dealership and the sergeant was there. I was like my first 2 weeks on duty. And the sergeant said to me, Gower, have you ever led entry into a building before? Have you ever been first in? And I said, no, I've only been on for 2 weeks. So I expected her to send me off, go 3 blocks away and stand on a corner. But instead she said, okay, you're in. So I was terrified. So of course I went in slicing everything super slow and was immediately washed over by everybody else who just went straight in, done. So, and it's kind of the same with real estate. You can learn from books and I'm not, the lesson I suppose is what the lesson I would say in real estate is don't forget the lessons you learn from books or from people like me who've really been through it, who have lost everything, who have seen it multiple times. Global financial crisis. I saw how everybody lost money in those days, even though I did very well in the GFC. But be careful. Don't lose sight of the fact that it is high risk. So anyway, I've never shared that anecdote publicly before, but anyway, that's how it goes.
No, but I totally agree. Like you've been through now savings and loan, the internet bubble,
right?
Then the
global financial crisis, the GFC,
Great Recession,
yeah,
and now they don't really call it a recession, but the bubble kind of popped, if you will, with real estate once interest rates started to climb.
Mm-hmm.
So you've been through at least 4 that I can count, and for me, this will be my first one. But what it does with an investor, it makes you a smarter investor moving forward. So it teaches you where to go and how far to go with your leverage, if anything else.
Absolutely right. I mean, you've also got to keep in mind, though, Cedric, that first of all, memories are very short.
Yes.
And it's also easy to just remember the last thing that kind of stands out. So I'll explain what I mean by that exactly. So what I hear a lot of people saying is, oh yeah, I've learned never take on variable rate debt. Okay, yeah, that's what I've learned from this experience. Yeah, but no, I'm sorry, that's oversimplification. The bottom line is if that's all you learn, you'll miss the next era. The big picture is you've got to, debt itself is the killer. Debt is the killer. So when you underwrite a deal, you've got to underwrite to 3 scenarios. And I learned this from my institutional real estate experience. I worked for an institutional shop for a while between the bank and going to Colony Capital. And you've got to underwrite 3 different scenarios: best case, worst case, and most likely case. All right. So these are the 3 scenarios you want to be underwriting to. But importantly, You should be always underwriting. And it's really difficult to do this because the temptations are too great to go outside of this bubble, or these criteria. But you should really only invest if your worst case scenario is manageable. So a good way to look at worst case scenario is to look at a location, do your research and figure out how bad did this location get during the global financial crisis? How far did rents get pushed down? How far did cap rates get pushed up? What kind of decline in values were there in this area? And set that as your worst case scenario. Underwrite to that with your debt. So if you have lower debt on it, and there's a place in every deal for every kind of debt. You might want variable rate debt under certain circumstances. You might want fixed under certain circumstances. I mean, it really does depend. But if you are underwriting whatever your debt is to survive a worst case scenario, two things will happen. One, your projected returns will be lower than they would be if you were to crank up your debt and assume only good things will happen. But that's okay, because the second thing that happens is you are now insulated against the worst possible outcome. So what that means is that if and when there is another major downturn and property prices collapse, which they will do again, you will not only survive that downturn, but you will be one of the few who come out of it with cash flow or cash flowing assets, low debt, and the ability, and if you do it right, good relationships with your lenders. So you will be very well positioned to buy highly discounted assets. And that is the moment that actually real wealth is built. Real wealth is not built during the good times.
Correct.
It's built on the upturn on the uptick from a downturn when you buy distressed assets. That's when real wealth is built. So you want to be preparing for that.
Right. 100% agree. So, Adam, you've raised over 500 million and helped others raise $1 billion plus. What key lessons did you learn in the trenches of capital raising before going digital?
Tell a story. It's all about storytelling. Okay. And I don't mean fiction. I just mean people want to know the story of a deal. And you know, it's funny. I think of it this way. When I was first, I told you I was kind of hauled in, or my job was to stand in front of these ultra high net worth investors. Again, I was super young. I started, again, I'm trying to think, 64, 60. So I was 22, really young doing this, and just barely out of university. And I just had this intuitive sense that the first thing I want to do, and I think of it like going to a restaurant, Cedric. When you go to a steak restaurant, right? There's like this, what's it called? Ruth's Chris. They like to do this. Right? I don't know if you have them where you are, but where I'm at this restaurant for Ruth's Chris. And when you're sitting there waiting to be served, somebody will have ordered something that's on some red hot platter, and they'll walk through and there's steam and there's just deliciousness coming, sizzle, right? There's just this great sizzle. And it gets you anticipating, okay, where's that on the menu? I want that. It gets you ready to eat. And it gets you ready to eat in huge quantities, right? That's how I thought of presentations. I may not have connected the stakes to this in those days, but I realized that you open with sizzle. You want to open your presentation with something that excites the prospect, excites your investor, and we've actually woven this into how we do presentations now extremely effectively, how we do webinars, how we do launches. If you do it right, you shouldn't be spending any time at all talking about your background on a launch webinar. all of that should have been, that already should all be on your website. It should be in detail on your website. So you want to get straight into the meal. Nobody cares how the restaurant was built, right? Or how long experience the chef has got. All they want to know is, how quickly can I get my steak, right? It's the same thing. So, but you can say, look, if you're interested in who we are and our background, go to the website. It's all there. Today, I'm going to tell you about this amazing deal. And you show images. You can show befores and afters. You can show renderings. And then you want to talk about the returns that you're going to be delivering. And then you transition into how you're going to do it. And then eventually you transition to how to your pitch directly. So that's kind of the first thing that comes to mind, Cedric, when I think about your question is get people excited and anticipate what's coming. And then, of course, you've also got to lead with FOMO. You know what FOMO is, of course.
Yes,
Fear of missing out.
Yep.
So we have developed a formula for building FOMO that works exceptionally well. I'll give you one example. I'll give you an example. So we have a client. We just helped them earlier this year. We helped them raise 4.1 million in 4 hours. Wow. 4 hours.
Wow.
Check this out. The deal has no distributions for 4 years. No distributions for 4 years. And at least a 12-year life cycle. So imagine that. And yet we still financed it, fully subscribed in $4.1 million in less than 4 hours. It was a total scramble. I set up the whole thing for our client. We launched the webinar, we launched the deal, and I couldn't believe how quickly it was filling up. And I had to scramble to shut it down because we didn't want it to oversubscribe and have to call somebody to say, sorry, we got to reject your subscription. So it was a panic. How did we do that?
Yeah.
2 things. I actually wrote about this on LinkedIn. 2 key things. One, it took us 4 hours from official launch, but we'd actually started teasing this deal 11 months earlier. So people were anticipating this thing coming along and understood that this was not going to have any distributions for 4 years and was a long-term project way in advance. So by the time we actually launched, everybody, like Ruth's Chris, right, like your steakhouse, everyone was anticipating it. It's the same thing, right? You see it with, again, just kind of going back into this analogy of a local restaurant. You see a restaurant that you've been dying to see, that suddenly is going to open, coming soon. Mm-hmm. And as soon as it opened, there's lines around the block. Why is that? Why do those lines die down? It's because you've got to, in those first few days, that's when you capture most interest. And with a real estate deal, it's the first few hours after you launch. But it takes a long time of careful preparation, deliberate preparation to build that anticipation so that when you do open or when you do launch, it's a huge success. And the second thing is FOMO, fear of missing out. So the way that we do that, very simply stated, and we've, again, developed with all of our, again, my personal experience throughout my career, and then working with all our clients over the last however many years, 10 years, we've developed a launch formula that works exceptionally well. Okay. And the way that starts is you need to have ideally, we have some clients that they do a deal once every 18 months or so, and they'll call me up and said, we're going live a week on Friday, help. So now I've not got much time, but you can still, if you do it right over time, if you nurture your prospects in between deals properly, you can still do a last minute launch. I advise not to, but you can still do it. But ideally what you want to do is you want to have a sequence of teaser emails or teaser communication before your launch. Then you transition to a launch sequence that says, now we're going to be launching a week on Friday. Don't miss out. All right. So here's a cool way of thinking about it. Let's say you're going to raise $2.5 million and you've got a $50,000 minimum. then what's that? 50? Am I right? 50. So that's 50 investors, right? 50. There's only 50 spots. And you know that your average investment might be 100,000. It's only 25 spots in this thing, right? So you might say, so you want to use FOMO, right? So you would say, okay, minimum investment 50, only 50 spots, but we usually average 100,000. So it's really only 25 spots. So don't miss out. Launching a week on Thursday. And then you do a countdown sequence, launching in 3 days, launching in 2 days. Tomorrow, today, don't miss out. Launch halfway through the webinar, and then you'll spend the next week or two with a close sequence that builds FOMO. 70% subscribed, 80% subscribed, don't miss out, 90% gone. And if you do it right, some people, and you can actually, okay, so kind of black belt advice. But you can actually engineer it so that some people do miss out. And that makes them super anxious next time and incentivizes or motivates much faster action next time.
We know you're going to like this episode, so please like, comment, and subscribe to this channel so you can be notified when the next episode drops.
Right. Okay. So now, Adam, you're known as the world's leading expert in online real estate capital formation. What was the tipping point that convinced you to online syndication was the future of raising equity?
Yeah, it was really the realization when the Jobs Act passed, right? So this was 2012. I actually wrote a book called Leaders of the Crowds, and it was published by Palgrave Macmillan. And I interviewed some of the people who had been in the White House and Congress, some of the lobbyists, some of the early adopters of erroneously called crowdfunding. But the crowdfunding websites, what I realized at that point was that I've been raising money for real estate my whole career since the mid 80s. Even in Japan, when I ran Universal Studios, I still did it. We did some JVs or some joint venture partnerships with local dignitaries, the wrong word, local industry leaders. And so I continued to do, and then I raised money for my own deals. But it was always this tedious process, Cedric, of one-on-one meetings. And every single time you met, you got an introduction or a referral to somebody, you had to meet them, and you go through the same thing again and again and again. It's this you're parroting the same thing again. Really, really inefficient. But it was the only way you could do it. So it was the only way you were allowed to do it until the laws changed. And it was when I was watching these little startup companies pitching that I realized there was a common thread that ran through all of their pitches. It didn't matter what their business was. The common thread was digital marketing, Google Analytics, search engine optimization, SEO, whatever. They had all these CRM, ESPs, all these acronyms for digital marketing I'd never heard of before. And I realized that is how stuff is sold today. That's how it's sold today. And so when the laws changed and said, okay, now real estate guys, you can also use these tools. I mean, the law didn't actually literally say that. I connected the dots and I thought, oh my goodness, now we can do that. That was the light bulb that went off on my head. And so I basically taught myself how to do digital marketing. Funnily enough, the first thing I did was created a podcast. I got a PhD, Cedric. And that was a big deal for me because from one of the top universities in the world. And it was a big deal because it gave me credentials, a PhD after my name, that I realized almost no one else in the industry had. So it gave me it helped me get over imposter syndrome. And so I thought, all right, the first thing I'm going to do is I'm going to interview professors. in a podcast. I thought, yeah, I'll interview professors because then they'll take my call because I'm a PhD, I'm a doctor, right? So now they'll take my call. I'll do a series of podcasts, and so that's how I started teaching myself the art of digital marketing.
Okay. Now, how does digital capital raising differ from traditional methods, and why do so many talented sponsors still hesitate to make that leap?
That's such a good question. So the first part of the question is simple to answer. Scale. You can scale. Okay. Right. So when you go online, you're not talking to one person at a time. You're not one-on-one. You are one to everybody. I like to think of it as when you go online, you are now in front of everyone, everywhere, all the time. Right? It's amazing. Scale. You can scale. Put in systems, automations, you scale. And so you can scale your business. The reason that sophisticated sponsors tend not to adopt quickly is because it's so foreign to them. Since they're for generations, myself included, for generations, we just got used to raising money by joining the country club and meeting high net worth individuals that way, or calling your attorney or financial advisor. Can you introduce me to somebody? And kind of doing that, or donating to a philanthropic causes, and being a speaker at an event and just getting known, and people get to, I mean, it's just brain damage to do that. But it's been the way money has been raised in real estate throughout history, really. I mean, for the last, at least since 1933, but at least for livable memory, right? For anyone's memory. And so it's a big leap. People are uncomfortable with it. I mean, how many people know how to, as I wave my telephone in front of you, my cell phone as a prop, how many people know how to use their cell phone properly, right? I mean, it's just, people are, comfortable with don't like change.
Yes, correct.
And so they just want to keep on going the way they've always done it. It's worked for me so far, I'm not moving. But those that do adopt suddenly realize the power of and how efficient it can be. I'll give you one example. Actually, go on. So anyway, that's the answer to your question.
Okay. All right. So I do have another one for you. So what are the most common mistakes you see sponsors make when trying to raise capital online, even with the right tools at their fingertips?
Yeah, so there are a lot of mistakes, but one of the critical fails, all right? So this is an absolute never do critical fail.
Okay.
Never. First of all, there are no silver bullets, right? There's nothing that will suddenly cause money to come flooding in. It requires diligence, consistency, and effort ongoing. When you go online, the difference is you scale. So now you can raise more than you did before, but it doesn't mean it doesn't mean that you can stop trying to raise money. It's still a lot of work. But people do think that there are silver bullets, like do this and you'll raise gazillions, in your sleep. Okay. And one of those, so don't believe anyone that says it's easy and you'll raise money quickly. But one of those that is very seductive is to buy lists of accredited investors. Buy a list of accredited investors. You see this all the time. Buy this list, join our club, get a list.
Yep.
Well, never, ever do that. There are lots of reasons for it. Number one, if you're buying that list, trust me, hundreds, if not thousands, have bought it before you and blasted it. Anything you say is going to end up being ignored because they've heard it before. Secondly, worse than that, what's going to happen is that your domain, so your, cobbscreekcapital.com domain will be labeled a spammer. There are hundreds of what I call spam police out there. And what they do is they track all email traffic. It's all automated. It's like incredible, literally hundreds of them. They track web traffic or email traffic, and they send out signals that say, okay, this person is a spammer. They're sending spammer. And what they look for, it's all automated. What they look for, keywords, get it now, free. Last minute bonus. There's all kinds of words, lots of dollar signs in a subject line. I mean, there's all kinds of spammy words that they look for. But they're very sophisticated. And what they also look for is open rates, engagement rates, all kinds of things. So if you blast to a list of, and also what they also look for is the number of people who mark you as spam. So an email comes in and somebody says, this is spam, delete. And it's so easy to do that on your phone. You can do it with Apple. It's so easy to mark something as spam, right? Spam. If that goes, and I forget the rate, I think it's 0.2% or something. I forget. If you get that, if you get too many people marking you as spam, all the spam police out there start labeling you as spam, and you end up not being able to send emails to anybody. All your emails are labeled. Your domain ends up being blacklisted, and you end up going into spam boxes. So that's number one rule: never buy a list and blast to it. There are other ways of dealing with lists that we use. Again, these kind of super advanced methodologies for getting through to people on those lists. But the one way to not do it is send out emails to them.
Okay. Now, Adam, you said it's not the tech stack, it's how you use it. What does that mean in practice for real estate developers trying to scale their investor base?
Yeah, there has been in recent years, or at least I'd say probably in the last year, maybe two, there has been a trend. And it's actually a long story, but there are certain platforms, tech platforms, that promise to do everything, right? Well, it does everything. We do text, we do email, we do this, we do that, we can do something else, and this, that, and the other. If you want, I mean, there's one in particular that comes to mind. And the way that these tech platforms are structured, but actually I'll mention it. So Go High Level is the kind of the key one that I think of. Go High Level is basically the way it works is that you can resell it, as you know. You can resell it and collect 100% of whatever you resell it for. Well, how can that possibly work? Right? How does the parent company make money if they're not collecting? You pay them $497 a month, and you've got 1,000 people paying you $497 a month. How do they make money? How does that work? You got to think about how that works.
Right.
The way it works is very simple. Incremental charges for emails and text messages, they look small to you. 1 cent here and half a cent there and 2 cents here. That all flows up to the mothership. That's how they make money. But the problem with that is it incentivizes bad email practices, back to deliverability. So their deliverability levels are really low relative to others. You don't know that as somebody on the platform. So what's happened is, because it's so lucrative to basically, and forgive me for using this term, but to peddle this software to other people, what's happened is a lot of people have come into the capital raising for real estate industry, peddling this software. Really, their only incentive is to get more people to use the software. But what they don't understand is that it's, first of all, that the software itself is kind of at its core flawed, but that it doesn't really matter how you deliver your message to your prospects. It's the message that you deliver that counts. That is the message that counts. And so what you also see, these kind of quick fix, again, silver bullet solutions. Here, we can do everything for you in one package. Don't trust the silver, but you're a military guy. You know there's no such thing as a silver bullet. You can't fire one thing and solve the problem, right? You got to be persistent, consistent, and be accurate and precise with everything that you do. So there's no one size fits all solution. What is really critical is that the messaging that you put out there is uniquely you. And that's what is missed. You can buy the software, these kinds of software that they come with templates. There's a template for this and a template for that, and just copy my stuff and, tailor it to you. And so what you end up with, especially with AI, is you get the same messaging from thousands of people, all repeating the same stuff, using the same, platforms. And so what happens is two things. One, an enormous amount of noise, and two, everyone sounds the same.
Right.
That is not how to raise capital. To raise capital, you have to be your prospects have to come to know, like, and trust you. So you have to be yourself. That's a whole long conversation. Yeah. But the key is honesty and integrity and authenticity. And those are the skills that I bring to our clients. The tech stack, we have best of class tech stack that we build for our clients based on their unique circumstances.
Okay.
But more than that, strategic guidance on how to message the audience so that people come to them, are predisposed to invest with them.
Okay, great. Now, what role does investor psychology play in capital formation, and how can sponsors better align their messaging with how investors actually make decisions?
Well, you've got to realize that, first of all, this, I'm assuming, as well as I do, over the last few years, a lot of sponsors have stopped distributions, done some capital calls, and in increasing numbers lost deals to the bank. So they've lost investor money, all of it. So investors have lost money, and they are immune now to these often repeated repeated messaging like earn passive income, build wealth, and gain financial freedom. They're sick of that messaging. When did you? I was talking to somebody yesterday. When did you? Who comes from one of the big platforms, who was in charge of investor relations? How often do you speak to an investor and you say, okay, so why are you looking at real estate? How often does an investor say, oh, because I want to gain financial freedom? No one ever says that.
Never.
So why it blows me away that people lead with that as though that's going to attract investors to them. Investor psychology is that they've been made promises over the last few years that have been not delivered. They've lost money. So they are upset, right? They have lost faith in this kind of vanilla messaging that everybody puts out there, right? This is the kind of sameness. They're sick of it. So, and the one thing that you should always lead with when you do your messaging is that which is the greatest concern to investors. You got to lead with the biggest concern. So what the investors are worried about today is protecting their capital. I know this because we did a multi-sponsor investor sentiment survey not long ago. And investors are most concerned with protecting their investment. They don't want to lose it. So the first thing that you should be leading with, particularly in this market, is how you do that. And if the way that you do that is by saying, yeah, we protect our investor capital by taking on less debt, and therefore our projected returns are lower than everybody else's or other people, that should not bother you. In fact, that's how we protect your investment. If the best case scenario comes out, this is our projected IRR, but I'm not going to lead with that. I'm going to tell you that our projected IRR is down here because our number one priority is don't lose money. That's our number one. Okay, now you've just won your investors. Okay, I got it. Now you can tell them everything. If you don't address that concern first, all they're going to be thinking is, well, yeah, the last guy promised me 25% IRR, and I just got a notice that he lost it to the bank. Meanwhile, he charged me a disposition fee. So he made money losing me money. Right. So, okay, but now I trust you better because now you've explained, all right, so your projected IRRs, etc. You've addressed my concern. Tell me more.
Right, right. Yeah, that's the biggest thing that they want to know. An investor wants to know, how are you going to protect my capital? And that's primarily, I mean, for me, that's my number one thing before I invest other people's capital into my deals or other people's deals. How are they going to be protected? Because that's the number one thing. Don't lose their capital. And you may agree or may not agree with this, but most people, for the most part, yes, they want to get that return that you promised them. But their biggest thing is don't lose the capital that I've entrusted to you. Let's talk about the system you've built and what pillars of successful digital capital raising strategy that sponsors can use to scale.
Okay, so the most important thing is content. You've got to develop content. It needs to be authentic. You can't just say to AI, give me 20 articles and write them all for me about real estate investing and lob those on your website.
Yeah.
That's not going to get you anywhere. It's a waste of time. And you won't raise money and you'll lose trust. It's a waste of time. So you got to develop content that is true and authentic to who you are. Ideally, you want to have 20,000 words or so. So, 10 to 12 articles on your website that cover all aspects of your investment thesis, legitimate investment thesis, your thesis, your investment philosophy, your background, your history, the way you see the world. Don't worry if it's not as amazing as some of the big shops. It's going to take you decades to get that kind of experience. It doesn't matter. There are those people out there who will like you for who you are. That's all. And they will not like the big shops because the big shops to them will look like the big institutional, flashy, button down suit kind of guys. And they won't like those people, right? That's not me. But they will come to know, like, and trust you. So the key is whatever content you put on your website, make sure it is your voice, legitimately your background. You can certainly use AI to help you, but you have to do the initial content. You have to write the initial thoughts because AI doesn't know what your thoughts are about the IRR, why you like multifamily, or why you like this geography or this region. So you've got to teach it, and then it can help you write the content. So content is the single most important thing because what it does is it does all the hard work of educating your prospects so that when they meet you for the first time, if they do on a Zoom call or in person or on a webinar, they've already done their research for you because you've already provided them with everything they need to know about you. So they don't need to ask you, who are you? What do you do? Why do you like this and that? What's your investment thesis? But they've learned it already. Now all they care about is the deal that you've got, and they're predisposed to invest. So content is king in this case.
Adam, it's been a blast having you as our guest today. And as we close out, please tell our listeners where we can learn more about you, get in touch with you, and learn about all the fabulous things you have going on right now.
Thank you. So the best place to find me is at gowercrowd.com. So that's my first name. I'm sorry, my last name, Gower, crowd.com. And I have a newsletter, Cedric, that goes out whenever I do podcasts, actually, these days. So it's free. You can always unsubscribe. It's very detailed. And I communicate a lot through the newsletter. And then I actually have a training coming up. I think it's actually probably going to be late August. I'll probably start in about 3 weeks, where I will, for the first time in 3 years, I'm going to be training people on exactly how we do everything for our private clients. So our private clients tend to pay us in excess of $100,000 to build these systems for them. But the training obviously is a tiny fraction of that. And I'll just handhold you through the whole process and show you how to do it. So if you sign up to my newsletter, you'll get more info about that.
Awesome. That's great. That's great. Adam, again, I want to thank you for your time today and all the wisdom you have provided to our listeners. is greatly appreciated. And I want to thank you, our fans, for tuning in to the Syndication Real Estate Podcast, where we want to add value to you in your investing business. Please tune in to our next episode, where we will definitely interview another fantastic investing professional. See you next time.
Thanks for listening to the Service to Syndication Podcast. We want you to know that we love and appreciate your support, and we are grateful about being a part of your journey to becoming a successful real estate entrepreneur. Please share this episode with a friend who you think will get a lot out of what you just heard. Send it to someone who you know is interested in real estate and dreams of having it all and being the best they can be in all areas of life. And if this was really valuable, share it on your social media stories and timelines. Thank you for watching and listening. Now go be great.